Hello, welcome to ACC F3 Financial Accounting. Today we will be learning about IAS 37, Provisions, Contingent Liabilities, and Contingent Assets. Firstly, we're going to begin off with provisions. Let's get into the definition of provisions first. Now, IAS 37 has provided a definition for a provision. It is a liability of uncertain timing or amount. So the thing about provisions is that we are in this position where perhaps a customer, let's say, has sued us for some certain wrongdoing that our company has done. And we're not quite sure whether this legal case is going to be completed anytime soon or at what amount. And even if there is an amount, we have to make sure that there is a reliable estimate for that. So the point is that we have to set aside some funds or some sort of economic benefits. It could be in a different form, not just cash. It could also be in a form of like an asset in order to settle this legal claim. So in this position, we're the one who has to owe this economic benefit, and we're not quite sure exactly when yet, but we know for sure that it's bound to happen, meaning we're really sure that we are going to have to give this economic benefit to whoever is suing against us or who is claiming against us. So the next question is, how do we recognize a provision for the first time in our financial statements? Well, there are three criteria that all have to be met. Okay, I repeat, all of these have to be present in order for us to recognize a provision. So the first one is that we know that we have a present obligation. Okay, so the past event has happened. I have been sued, or I have been facing a legal claim in my financial year, so I know that I do currently owe someone some economic compensation. Next, a transfer of economic benefits. Okay, I'm writing ECO for short, but it means economic, is probable. Now note how this word is probable, okay? Because in later definitions, we're going to need to differentiate between probable and something else. So probable means that there is a high chance, so there's a greater than 50% chance that we are going to have an outflow, whether it's a cash or an asset. And we know that the amount to be transferred has a reliable estimate. Okay, so that means we can accurately estimate that this compensation is amounting to $100,000 or $200,000. If it's not reliable and if it's just like a random guess, then we cannot say that we should recognize a provision. So now we're going to consider the measurement of provisions. If we're talking about initial recognition, meaning that we just created provision for the first time, then the double entry would be debit our expenses in the SOPL by the amount of the provision, and we should credit our provision account, which is shown under the current liability heading in the statement of financial position. So for example, you can assume that, let's say, my company is facing a legal claim and it's arisen during the year. And I can say that there is a 60% chance, well, I'm not going to be the one saying it. My legal experts, my lawyers, are the ones who are going to tell me that I have a 60% chance of the result being me having to pay whoever is suing me, my customer, $1,000. So in this case, what I am going to do is I'm going to recognize immediately in my statement of profit or loss $1,000 of expense, and I'm going to create a provision of $1,000 as well. So even though I have not resulted in this outflow yet, I'm still just setting aside $1,000 for safekeeping just in case I do have to give that $1,000 to whoever's suing me. Now, when we're talking about subsequent measurements, we need to consider whether it will increase or reduce, meaning whether this amount is going to change to be higher next year or lower next year. So there are two options. There could be an increase in provision or there could be a decrease in provision. And both have different adjustments. So let's say I'm going to give an increase example. Let's say this year I've already recognized that $1,000 provision, and in the following year, when the legal case is still being investigated, my lawyers say, well, you now have a greater chance of having to settle this claim, but at a different amount. They estimate I have to now have an outflow of $1,500 to settle the claim. Now, last year I already made a $1,000 provision, and I already expensed that. So all I need to do is further increase my provision by the different amount. So in this case, I'm going to debit my expenses with the 500 being 1,500 minus 1,000. Because I already expensed it last year, I don't need to expense the whole thing again. Okay? So all I need to do is just add the additional 500. And so the same thing would go for my provision. It will be credited by 500. Okay? But what if the scenario was a decrease? Okay, what if it was a decrease? Let's say instead of them saying 1,500, they figured it would be $700. Okay, let's say last year I recognized a $1,000 provision, and now I have to recognize a $700 provision instead. So we can see that it has decreased by $300. So what do I do with my current provision? I simply just need to debit the amount. Okay, I need to reduce my liability. So what I'm going to do is I'm going to debit my provision with 300. Okay, how I got 300? 1,000 minus 700. And then I need to credit my expenses, 300. Okay, now expenses are not normally supposed to be on the credit side. What I mean is that I'm reversing the expense adjustment from last year, okay, through my retained earnings. It's kind of like I'm giving back to my retained earnings from last year by crediting the amount. You only need to adjust with the difference, not the whole amount. Please be aware of that. Okay, now we've completed provisions. Let's get into contingent liability. Now, contingent liability is quite in the same case as a provision. We are in the position having to have an outflow at some point to settle a legal claim. But what is the difference actually? Now, with provision, we have to have those three criteria in order to recognize a provision. But with a contingent liability, it is a possible obligation. Okay, now possible means that there is a 50-50% chance. I don't know for sure if I'm going to have to pay this cash in settlement, or maybe I won't have to. Or there is another possibility. There is a present obligation. Okay, so same scenario when creating a provision. We know that an obligation exists when we have to recognize a contingent liability. We have a present obligation, but there is no reliable estimate. Okay, meaning that we know that we owe this money, but we don't know at what amount it should be. Okay, or it is not probable that there will be an outflow of economic benefits. Okay, so it's less than 50% chance that we're going to have to settle this claim anyway. But we still have an obligation to this person. So we still need to put some kind of disclosure about this liability. So how is this treated? It is not recognized as a liability in our financial statements, okay? It is not treated the same way as a provision. So we do not disclose a current liability, contingent liability in the SOFP, and we do not recognize an expense either. But what we do is we simply disclose to the account. So we have to create a disclosure note to inform our stakeholders that we have a contingent liability existing. So there are easy ways on how to recognize a provision or a contingent liability. The key thing that you should remember is that if it is probable, then you recognize a provision. If it is only possible, okay, possible meaning a 50-50 chance, then you recognize a contingent liability. Okay, the C stands for contingent, not current. And there's another scenario where the case is remote. Remote means that it's a very small issue. Both chances are unlikely. There's no obligation, there's no estimate, there's no nothing. So all you have to do is do nothing. Now let's get into contingent assets. Now in this case, we are the ones who are supposed to be receiving the compensation, not the one who is having an outflow of economic benefits, but instead there is an inflow of economic benefits. So if we're going to talk about definition, a contingent asset is a possible asset. Okay, note how I've written down possible because there is again a 50-50 chance that arises from past events. So past events could be a case where I have settled for compensation from somebody else. Now the thing about a contingent asset is that we again do not recognize it as anything in our financial statements. We do not need to capitalize this. We do not need to set it under our asset figure or create an expense or income. Note how it says possible, meaning that we're still unsure whether we are going to receive it or not. So when we see it as probable, only then we disclose to the account. Okay, we don't even need to recognize an asset yet. We just need to make a note and say that we have a contingent asset if it is probable. But if it is virtually certain, okay, note the words virtually certain, which could be a 90% chance, then we recognize as an asset in our financial statements. So let's get into some question practice. An ex-director of X company has commenced an action against the company, claiming substantial damages for wrongful dismissal. The company's solicitors, in this case like the lawyers, have advised that the ex-director is unlikely to succeed with his claim, although the chance of X paying any monies to the ex-director is not remote. Okay, so let's take a look at the vocabulary they have used. In this case, we need to listen to what our lawyers are telling us. They say that the person who is suing us is unlikely to succeed, but we do still have a present obligation because we have conducted wrongful dismissal according to the ex-director, okay? But the chance of us having to pay for any compensation is not remote. So definitely we're going to have to either recognize a contingent liability or a provision. The solicitor's estimates of the company's potential liabilities are legal costs, which is to be incurred whether the claim is successful or not, and settlement of claim if successful. So currently we've hired our lawyers and we know that we have to pay these legal costs of $50,000. This is definitely we're going to have to pay. So we know that there's a reliable estimate, $50,000, and it is probable of us having to have an outflow of $50,000. So we can say that for the legal costs, we should recognize a provision. Okay, because no matter what, whether we succeed or not, we're going to have to pay that $50,000. So we're going to debit our expenses, $50,000, to our SOPL, and recognize a provision, $50,000 as well, in our statement of financial position. Now how about that settlement? It says that if successful, it's still an if, we're not quite sure yet. So this is a possible obligation. So if it is a possible obligation, we are going to disclose as a contingent liability. Okay, now let's take a look at this question. Which of the following statements about contingent assets and contingent liabilities are correct? 1. A contingent asset should be disclosed by note if an inflow of economic benefits is probable. Okay, two words here are disclosed and probable. This is in fact correct if you refer to our slide before. Next, a contingent liability should be disclosed by note if it is probable that a transfer of economic benefits to settle it will be required with no provision being made. Now note there is a difference between an asset and a contingent liability. So if a contingent asset, if it is probable, you disclose. But if a contingent liability is probable, you need to make a provision. Okay? Because a contingent liability is a possible obligation. Okay? So possible and probable are different. So this one is wrong. 3. No disclosure is required for a contingent liability if it is not probable that a transfer of economic benefits to settle it will be required. Now note here that even though it's not probable, but if there is a contingent liability, you still need to disclose. Okay, you still need to disclose, so this is also incorrect. No disclosure is required for either a contingent liability or a contingent asset if the likelihood of a payment or receipt is remote. Now note here they've said remote. Remote applies to either scenario. If it is remote, meaning less than 5% or 10% chance, then we don't have to do anything. So no disclosure would be the appropriate action to take. Let's take a look at this one. Wanda Co. allows customers to return faulty goods within 14 days of purchase. At 30 November 2005, a provision of $6,548 was made for sales returns. At 30 November 2006, so this is a year later, the provision was recalculated and should now be $7,634. What should be reported in Wanda Co.'s statement of profit or loss for the year to 31st October 2006 in respect of the provision? Let's make some notes here. This is the opening provision from last year, and this is the closing provision figure of this year. Now we need to recognize this adjustment. Okay, so if in the beginning we had 6,548 and then it became 7,634, what we need to do when recording in the SOPL is to simply record the difference, okay, not the whole amount. So in this case, we're going to have a charge of 1,086. A charge meaning we're going to have to increase the expense amount. So we're going to expense the difference, which is $1,086. Okay, let's take a look at this one. Doggart Co. is a business that sells second-hand cars. If a car develops a fault within 30 days of the sale, Doggart Co. will repair it free of charge. At 30 April 2004, Doggart Co. had made a provision for repairs of $2,500. At 30 April 2005, Doggart Co. calculated that the provision should be $2,000. What entry should be made for the provision in Doggart Co.'s statement of profit or loss? Okay, this is the opening figure because it says 2004, 30 April, and this was 30 April 2005, so this is our closing provision amount. So if in the beginning we had 2,500 and then we decreased our provision, that means we had to decrease by 500. So if last year we had recognized an expense of 2,500, this year in 2005 we should credit that expense. So we are going to credit our SOPL, okay, so credit our expenses by 500. We have come to the end of the chapter. Thank you for watching.